From the heart of the nation's capital, this is the Evening News. Breaking news starts now.
At 2 o'clock Friday afternoon, a single White House headline detonated across the global financial system. And the first casualties were not politicians, but ordinary savers watching their screens turn red. Silver collapsed in a historic wipeout the moment Donald Trump named Kevin Warsh as his pick to lead the Federal Reserve. What looked like a personnel announcement instantly became a geopolitical signal flare, because markets did not hear a new chair. They heard a new doctrine, tighter money, a stronger dollar, and a different kind of American power projection. What followed was not a routine correction. It was a violent repricing of power. The sell-off did not behave like a normal downturn. It unfolded like a forced evacuation. Within hours, silver futures recorded one of the sharpest intraday collapses in modern trading history. Major outlets such as Reuters documented severe volatility across precious metals, describing one of the most dramatic single-day moves since the early 1980s as traders rapidly adjusted to expectations of tighter policy and a firmer dollar. The U.S. currency strengthened, metals sank, and volatility spiked, the textbook reaction to hawkish monetary signals amplified by algorithmic trading. Behind that violence sits a simple but uncomfortable truth. In today's financial architecture, price is a proxy for policy credibility. Kevin Warsh is widely known for criticizing excessive balance sheet expansion and warning against inflation complacency. Markets immediately interpreted his nomination as a signal that the era of reflexive liquidity support, the so-called Fed put, may be fading. When machines scan headlines and detect words associated with tightening, they do not pause for nuance. They execute. The shock intensified when exchange mechanics kicked in. CME Group raised margin requirements on key metal contracts, forcing leveraged traders to post additional collateral. Reuters linked this step to accelerating liquidation pressure, noting how higher margins can transform fear into cascade. In highly leveraged markets, margin hikes are not technical details. They are accelerants. Traders unable to meet new collateral demands must sell. Selling triggers more price drops. Price drops trigger more margin calls. The spiral feeds itself. But this is not merely a trader's story. It is a geopolitical one. Because monetary policy is not just domestic housekeeping, it is strategic positioning. The United States dollar remains the backbone of global trade and sovereign finance. When Washington signals that capital will become more expensive, that liquidity will be restrained, the message travels instantly to emerging markets, commodity exporters, and heavily indebted governments. A stronger dollar can stabilize American purchasing power, but it can also pressure foreign currencies and strain fragile economies dependent on dollar funding. This is why the nomination resonated far beyond Wall Street. Reuters and other financial outlets framed the move as a dramatic shift in expectations. A market that had been positioned for easier policy suddenly forced to contemplate discipline. Axios described the nomination as the catalyst behind a brutal reversal in metals after a sustained rally. Business Insider highlighted how speculative positioning magnified the collapse once the narrative flipped. The deeper layer is structural. A hawkish Federal Reserve chair implies tighter financial conditions, which in turn influence treasury yields, credit spreads, and global liquidity. If bond yields rise materially, debt servicing costs increase, not only for American households and corporations, but for governments around the world whose obligations are tied to dollar rates. In a globalized capital system, monetary tightening in Washington reverberates through Asia, Europe, and Latin America within hours. The comparison many analysts quietly make is to the Volcker era, the early 1980s moment when aggressive rate hikes crushed inflation at the cost of recession. Reuters has frequently noted that today's economic structure differs significantly from that period. Debt levels are higher, markets are more interconnected, and digital trading accelerates feedback loops. Yet the psychological echo is unmistakable. The market's reaction to Warsh's name suggests traders fear a willingness to tolerate pain in defense of currency credibility. Even the more sensational online narratives, claims of manipulation or systemic breakdown, orbit around a more verifiable mechanism. Leverage met repricing, met forced liquidation. Major reporting has not confirmed exchange default risks or institutional collapse scenarios. Instead, coverage consistently attributes the magnitude of the move to a violent unwind of speculative positions triggered by policy expectations and margin dynamics. Still, the political implications are explosive. A United States that defends the dollar through monetary restraint strengthens its global authority but risks domestic backlash if asset prices suffer. A United States that prioritizes liquidity and market calm may ease short-term volatility, but risks undermining long-term credibility. In naming Warsh, the White House appears to have chosen a direction, or at least signaled one. The silver crash, then, is not merely about metal. It is about trust. Trust in central bank independence. Trust in the sustainability of American debt. Trust in the dollar's reserve status. When a single announcement at 2 o'clock can erase vast amounts of paper wealth within minutes, it reveals how fragile confidence can be in an age of hyper-connected markets. Now attention turns to the deeper foundation beneath commodities, the bond market. Because if metals were the first asset class to absorb the shock, sovereign debt may be next. And that arena does not just influence traders. It influences governments, alliances, and the future balance of economic power. If the silver collapse was the visible explosion, the real tectonic pressure is building beneath the surface, inside the United States Treasury market. Because commodities react fast, but bonds define the rules of the global system. And when expectations around the Federal Reserve shift, the bond market does not simply move. It recalculates the cost of empire. The nomination of Kevin Warsh instantly forced investors to reprice the probability of sustained higher interest rates. A hawkish Federal Reserve chair implies tighter liquidity, reduced balance sheet expansion, and less tolerance for inflation overshoot. In practical terms, that means upward pressure on Treasury yields. Reuters and Bloomberg have repeatedly emphasized that rising yields tighten financial conditions globally, increasing borrowing costs across sovereign and corporate balance sheets. The United States currently carries more than $36 trillion in national debt. As widely reported by the Wall Street Journal and the New York Times, higher yields directly translate into higher interest expenses for the federal government. Even modest increases in long-term rates can add hundreds of billions of dollars to annual servicing costs over time. This is not abstract theory. It is arithmetic. If 10-year Treasury yields were to approach 6%, a level some analysts discuss in stress scenarios, the fiscal math becomes uncomfortable. Debt servicing begins to compete with defense spending, entitlement programs, and infrastructure priorities. That is where monetary policy stops being technical and becomes geopolitical. Because the credibility of American debt underpins the dollar's reserve status, and the dollar's reserve status underpins American strategic influence. Historically, the bond market has disciplined governments that ignore fiscal realities. The phrase bond vigilantes was born from this dynamic. Investors who demand higher yields to compensate for perceived risk. During previous tightening cycles, including the early 1980s under Paul Volcker, aggressive rate hikes eventually subdued inflation, but at the cost of recession. Today's environment is more complex. Globalized capital flows, algorithmic execution, and derivative exposure amplify every signal. When yields rise, capital flows toward the United States, strengthening the dollar. Reuters has documented this repeated pattern. A firm dollar pressures emerging market currencies and commodity prices simultaneously. Countries with dollar-denominated debt feel immediate strain. Their central banks must either raise rates defensively, risking domestic slowdown, or allow their currencies to weaken, increasing import costs and inflation. In both cases, Washington's monetary direction becomes a global constraint. This is why the Warsh nomination triggered anxiety beyond Wall Street. A disciplined Federal Reserve could mean less tolerance for financial repression, the practice of holding yields artificially low to ease debt burdens. Warsh has previously criticized excessive balance sheet expansion and signaled support for restoring central bank boundaries. Markets interpreted that as a shift away from emergency-era policies that have defined the post-2008 landscape. Meanwhile, global banks are watching carefully. Under Basel regulatory frameworks, capital requirements tighten when volatility increases. If rates remain elevated, banks holding large portfolios of low-yielding bonds face mark-to-market losses. This dynamic was visible during recent banking stress episodes, when unrealized losses on Treasury holdings pressured balance sheets. Mainstream financial coverage has highlighted how rate volatility exposes fragility in leveraged institutions. The geopolitical overlay intensifies the stakes. China, Japan, and major oil exporters hold significant volumes of U.S. treasuries. Their confidence in American fiscal sustainability influences global capital stability. If tightening strengthens the dollar but undermines growth, geopolitical rivals may exploit the tension by promoting alternative trade settlement systems. Discussions of de-dollarization have appeared periodically in Reuters and Financial Times analysis, though the dollar's dominance remains entrenched. At the same time, a strong dollar can reinforce American leverage in sanctions regimes. When liquidity tightens, access to dollar clearing becomes even more strategic. Countries under economic pressure must negotiate within a system denominated in U.S. currency. Thus, monetary discipline can simultaneously constrain domestic borrowers and strengthen foreign policy leverage. Yet the paradox is sharp. Too much tightening risks recession. Business Insider and Bloomberg economists frequently warn that aggressive rate paths can invert yield curves, a historically reliable recession signal. An inverted curve reflects expectations of near-term tightening, followed by economic slowdown. If growth falters, tax revenues decline, while fiscal deficits expand, compounding debt challenges. This is where the bond market becomes the true battlefield. Silver's 37% collapse was dramatic, but Treasury yields determine mortgage rates, business investment costs, and sovereign creditworthiness. If investors begin to doubt Washington's ability to balance inflation control with debt sustainability, volatility in bonds could exceed anything seen in metals. Moreover, algorithmic trading magnifies bond market sensitivity. Electronic platforms execute billions in Treasury transactions daily. A sudden repricing can cascade across derivatives tied to interest rates, from swaps to mortgage-backed securities. Financial Times has repeatedly described how liquidity in government bond markets can evaporate during stress, amplifying swings. The deeper question emerging from Friday's shock is not whether silver will rebound. It is whether the United States is preparing to accept economic pain to defend long-term monetary credibility. A hawkish pivot strengthens the dollar, but tests domestic resilience. A dovish reversal calms markets but risks eroding purchasing power. In short, the nomination has reframed the debate. Is American power best preserved through liquidity and growth, or through discipline and restraint? The bond market will answer that question more decisively than any commodity chart. And if yields begin to climb in earnest, the tremors will not stop at trading desks. They will ripple through alliances, supply chains, and sovereign budgets, setting the stage for the next confrontation in this unfolding monetary drama. If bonds are the foundation of the American financial state, then commodities are the bloodstream of the global industrial order. And what began as a shock in silver is now mutating into something far more strategic. A confrontation between paper pricing and physical control, between financial dominance and resource sovereignty. While futures contracts on exchanges such as COMEX absorb the initial liquidation shock, the deeper tension lies in physical supply chains that stretch from Peru to Mexico to China. The paper market can reprice in milliseconds. Mines cannot. According to long-term industry data published by the Silver Institute, global silver demand in recent years has increasingly been driven not only by investment flows, but by structural industrial usage, particularly in photovoltaics, electronics, electric vehicles, and advanced battery technologies. Companies such as Samsung Electronics and Tesla require silver in high-conductivity components critical to production lines. Solar panel manufacturers, in particular, have increased silver intensity in certain high-efficiency cell designs. That industrial reality introduces a geopolitical dimension that goes beyond speculative trading. Mexico remains the world's largest silver producer. Peru ranks among the top exporters. Any prolonged disruption, labor strikes, export controls, environmental regulations, or nationalization policies would reverberate through global supply chains. While major outlets such as Reuters routinely cover mining labor disputes and regulatory reforms in Latin America, no confirmed nationalization measures or export bans have been formally enacted at the time of reporting. But the possibility alone is enough to alter strategic calculations. Because resource nationalism is no longer theoretical. Mexico has already moved to classify lithium as a strategic mineral in prior legislative shifts. Peru has experienced repeated mining protests that temporarily restricted output. If silver were ever categorized as a strategic national asset, especially in an era of energy transition competition, Western industrial users would face a new supply risk layer. Meanwhile, the geopolitical axis of metals consumption is shifting eastward. China remains the world's largest solar manufacturer and a dominant refiner of multiple critical minerals. Shanghai futures exchanges often reflect domestic demand dynamics distinct from New York trading sentiment. While verified arbitrage data fluctuates daily, historical episodes have shown temporary price gaps between Western futures and Asian spot markets during periods of stress. This divergence highlights a broader theme. The center of gravity in commodity consumption is not always aligned with the center of financial pricing. When volatility strikes, physical flows follow logistics, not headlines. The strategic implications intensify when combined with currency dynamics. A stronger dollar can pressure commodity exporters whose revenues are dollar-denominated, but whose domestic costs are local currency-based. Conversely, if emerging market currencies weaken sharply, citizens in those economies may seek tangible stores of value. Financial Times and Bloomberg have repeatedly documented how gold and silver buying spikes during periods of currency instability in countries such as Turkey or Argentina. But the silver story is distinct from gold in one crucial way. It is both a monetary metal and an industrial input. Gold can sit in vaults indefinitely. Silver is consumed, embedded in circuitry, solar panels, medical equipment. Recycling contributes supply, but at lower price levels, extraction from electronic waste becomes less economical. If prices remain depressed for extended periods, marginal mines may curtail production. Business reporting frequently notes that sustained pricing below all-in sustaining costs can reduce output, tightening supply over time. This creates a paradoxical scenario. A crash driven by tightening expectations can simultaneously discourage supply expansion. Economics textbooks describe this dynamic clearly. When supply contracts while structural demand persists, price pressure eventually returns upward. But timing is unpredictable, and volatility can exhaust weaker participants before fundamentals assert themselves. Overlay this with the bond market tension described earlier, and a strategic dilemma emerges. If tighter monetary policy strengthens the dollar and compresses commodity prices, industrial consumers may gain short-term relief. Yet if fiscal strain forces a future pivot back toward liquidity expansion, the dollar could weaken abruptly, potentially igniting a rebound in metals. In geopolitical terms, this oscillation influences more than investors. It shapes defense procurement costs, renewable energy rollouts, and infrastructure budgets. Governments planning multi-year industrial policies require pricing stability. Extreme volatility complicates those calculations. Another layer of risk lies in custodial trust. During prior market dislocations, mainstream reporting has documented temporary delays in bullion delivery and vault audits. However, major financial publications have not confirmed systemic insolvency among leading storage institutions. Allegations of widespread double counting or Ponzi structures remain unverified claims in online discourse. Still, perception can be as powerful as fact in financial systems built on confidence. What makes this moment combustible is convergence. Monetary uncertainty, fiscal arithmetic, industrial transition, and geopolitical rivalry, all intersecting at once. The nomination of Kevin Warsh was not merely a personnel decision. It became a stress signal across currencies, commodities, and sovereign debt. For Washington, the stakes are immense. A disciplined Federal Reserve can defend purchasing power and reinforce reserve currency authority. But discipline tests markets. It tests governments reliant on cheap borrowing. It tests emerging economies balancing growth and stability. For Beijing and other rising powers, volatility in Western markets can be opportunity. Commodity accumulation during downturns strengthens strategic reserves. A fragmented pricing system weakens Western financial dominance. And for ordinary citizens, the retirees watching savings accounts, the workers whose pensions depend on market stability, the consequences are immediate. A 37% plunge in silver may not determine the fate of the world economy, but it exposed how tightly interwoven that economy has become. In the end, this is not simply a metals story. It is a referendum on monetary credibility in an era of record debt and geopolitical fragmentation. It is about whether discipline or liquidity defines the next chapter of American power. The deeper message is sobering. Markets can withstand volatility, but they cannot withstand a permanent loss of trust. If credibility fractures, in bonds, in currency, or in resource supply chains, the correction will not be contained to trading floors. It will reshape alliances and accelerate the global contest over economic leadership. So here is the question that now divides policymakers, investors, and voters alike. Is the United States strong enough to endure the pain required to restore monetary discipline, or will political pressure force another turn of the printing press, risking the very credibility it seeks to defend? Thank you for listening. Before you step away, share your perspective in the comments. If you found this breakdown valuable, hit like and subscribe, then turn on notifications so you don't miss the most critical political developments as they break, day after day. See you next time.